Interest rate volatility is making this an absolutely ruthless market to trade, seeing wild swings from one extreme all the way to the other based on news, and of course, how could we not mention the latest bank blowup? But like every week, we've got you covered with the best levels to trade from, as well as the indications for our markets based on intermarket dynamics, risk on versus risk off posturing, and hopefully after Wednesday, the FOMC rate decision, and the infamous J-POW press conference to follow, we'll get a clearer path forward as to how rates will continue to move here, and that volatility should decrease. As always, anything that we're associated with is linked down below in the description, so check that out. Quick thumbs up on the video before we get started is a great way to support the channel. And stay tuned until the very end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With all that said, let's dive right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, I would say that we've got a mixed bag of indications here. The upper wick certainly represents a rejection of the buyers up here at the top. Sellers stepped in towards the highs of the weekly range, but we know it's a green-bodied bar, so the close was in fact well over the opening print, and there's not a whole lot of lower wick here. There was no strong attempt from the sellers to initially push prices in the downward direction. We've closed roughly at the midpoint of the week's range here, so I don't really think it's fair to say that bulls or bears are in control from a structural perspective. Location will definitely make things easier to understand though. So on the location front, if we think about the bar to bar perspective, significant lower high as well as a lower low, which obviously stacks up as a bearish data point. If we think about all of the back tests of our support and resistance trend lines, these also strike me as bearish data points. If we do something like this, the all-time high anchored resistance trend line did provide resistance once again. You can see the upper wick failed to get above and stay above the resistance trend line. And on the back test of the support trend line anchored from the October low, you'll notice that the upper wick got towards it and then rejected. So sellers are hanging out on the back test of that support trend line. We've also closed underneath and rejected our weekly 50 SMA. That's the blue moving average on your screen. If we clear that up and take out the Fibonacci's from the low up to the high of this weekly move, you'll also note that we looked into the 38.2 bullish consolidation range overhead, but once again, that upper wick shows a rejection, and we've technically closed underneath the 38.2, so that does strike me as a bearish data point as well. Taking out the anchored VWAPs from the all-time high as well as the October low in here, just like the Fibonacci's, we have looked into the VWAP band range but closed underneath, the upper wick really representing more of a rejection of that range instead of price acceptance back within. Let's go ahead and throw back on the 50 and 200 SMA blue and green respectively. If we do something like this, I want to also draw your attention to the fact that the market closed right on the 390 structural element that's just oh so important on this weekly time frame chart. We've closed right on that area. If you start to think of the market as being more range bound in this area right here, it really represents the midpoint of the range, and recall that you don't have much of an edge, a competitive edge at the midpoint. Where do you have an edge? Literally at the edges for a breakout or mean reversion, and the same is true but opposite at the bottom, mean reversion or a breakdown. Doesn't mean that we just throw our hands up and surrender, but overall, obviously the weekly chart right now is not really giving us the clearest indications as we get caught up around this 390 area. If we think about trend and what's going on here, technically speaking, you've got lows, higher lows, and this is offering up a very nuanced higher low on the weekly time frame chart. But recall, now we need the equal high. Like there's no way around that. If we don't get an equal high here, the risk, of course, is that we form ourselves a weekly head and shoulders pattern, and breaking down underneath this neckline, you kiss it goodbye. A measured move from here to here, here to the neckline, takes us back down to the lows of October and potentially lower than that if the weekly and overall macro narrative continues to deteriorate into the mid stages of 2023. Before we go on down to the daily time frame chart, let's take a quick peek at our volume profile and see what's going on from this perspective. Obviously, we've closed right at the high volume node, so once again, the market is more content here. It's not giving us a clear indication as to who's in control. The market's always content at areas of high liquidity. This becomes a target, not an area to initiate new trades. You initiate new trades as you're moving through a low volume void, and you target the next overhead high volume node or the next underneath high volume node. Obviously, breaking down from the head and shoulders scenario that we just outlined like this, you can see there's quite a ways to fall from a volume support perspective all the way back down to the reset high prior to the sickness drop off, right? So I'm not calling for this in the coming weeks worth of trade. Hopefully through walking through the weekly time frame chart, you can see clearly here that we're at an area where the market's actually quite happy. If we move higher, we have targets and we understand understand the trend. If we form a lower high, we understand the pattern that's at play, and the risk, of course, is breaking down underneath that neckline. So right now, again, based on the structure, if it all boils back down to structure and where we've closed from a location standpoint, the weekly chart here is really not offering up a whole lot of competitive edge. Let's take a look at the daily and see what other supporting evidence we have. Expected move is always up first on the daily time frame chart. If you're not familiar with how to get these numbers, there's a tutorial in the top right hand corner for you. If we're contained by the upper edge of the weekly expected move, the number is roughly 402. Note that that would suggest a higher high being produced above last week's high. That strikes me as being a bullish indication, but at the lows, if we're contained by the lower edge of the weekly expected move, 378 even roughly, it would of course suggest the exact opposite, a lower low being produced. So expected move here is neutral in the sense that we could make a higher high, but we could also make a lower low. We could do both in the coming weeks worth of trade, considering that all of this volatility is being priced in because of the uncertainty surrounding the FOMC rate hike decision on Wednesday. So we'll see what takes place, but ultimately this does strike me as neutral. It's not skewed in one direction or another. If we think about the daily trend, it still remains down. We have ourselves highs, lower highs, and this very well could be our next lower high. Recall that on the lows in last week's video, we said, hey, probably doesn't make sense to short down here. We could get a counter trend rally, and we were really looking for 390, 350 to offer up some resistance for the lower high. We poked above, closed strongly above on the Thursday session, but Friday was the nail in the coffin, getting back down underneath 390, 350 and closing right on our weekly level around 389, 390 that we just discussed. So trend does remain down, and you could think of this as overall a daily bear flag pattern. Breaking the lows here should send us to the equal low, if not the low from the December range back in here. What else can we say about the overall patterns on the screen in front of us? We have rejected this overhead balance, right? The close inside on Thursday did strike me as noteworthy, but obviously Friday undoes that with pure price acceptance underneath 390, 350. We've rejected once again the daily 200 SMA on the Friday session. If we take out our Fibonacci's from the low of the move, the breakout bar back here to the top, we are still underneath our 61.8. Once again, we looked above, have come back down underneath at this point in time. That strikes me as a rejection of that overhead range. And if we throw on our anchored VWAPs from the important pivots throughout, basically after the bottom in October, notice again, here's your bottom, anchor, anchor, anchor. We are still underneath all of the VWAP band as of Friday's close, which does strike me as noteworthy. So the bears are kind of still in control here. If we think about what's going on from a structural perspective, it's just the fact that we didn't want to be new money shorts dead on the lows during last week's trading session. Now, if we take a look at the hourly structure, let's actually go ahead and clear those VWAPs up, go to the hourly chart here. I think the path forward that we outlined in the Wednesday video was, hey, if we get ourselves a double bottom, it's got to be the break of the neckline high here, aka that key number at 390, 350, then a higher low above becomes constructive for an uptrend. Obviously, Friday session turns this more into a look above and fail, right? You have look above, fail back down into the range. We always know that the target is the bottom end of the range on this particular pattern, so we should start to look out for 384.75. That, to me, is the key support as we move into the coming weeks worth of trade. If that breaks, recall that this is a short squeeze from the Monday session of last week. We should move through that relatively quickly, I would imagine. Then the breakdown really brings you back down to your December range lows. If I scrunch this up, you can see here at 379. Lower edge of the weekly expected move, 378. That's kind of how I foresee the downside playing out if we see downside in the first place. Now, the conundrum is that on the hourly time frame chart, if the buyers want to see an uptrend remain, we have lows, higher lows. This needs to hold. There's a higher low at 389 early on in the week, and we, of course, once again, need to poke back up and over 390, 350. So the structure on the hourly chart is quite clear. I mean, these levels have been well respected. The roadmap is there for us. It's just about determining what is most likely to unfold. And with some of the bearish reference points that we've been recalling in today's episode, I wouldn't be surprised to see lower highs off of 390, 350. It sets up this as kind of a head and shoulders pattern here. Then you break down underneath 384.75. That brings you to 379 on the downside. That seems reasonable. You could think of this as an hourly bear flag flushing 389, brings you to the bottom end of the range. That could be a scalp early on in the coming weeks worth of trade. Then we wait for like maybe a little bounce here, lower high again. You can just see how a number of different outcomes arise here, but the key levels that you need to focus on to keep it very, very simple into the coming weeks worth of trade, you've got 390, 350. Bulls are content above that level. Obviously, we need the constructive higher low. Anything that remains underneath, bears have control. And of course, the bigger breakdown is underneath 384.75. So the two key numbers, 384.75, 393.50. If you're only going to have two levels on your chart, those are the numbers. As we know, anything could go before FOMC on the Wednesday session, so keep an open mind. I would not be married to any particular outcome. Trade the levels, take profits aggressively in this market environment, and then wait for the next setup. Market internals are up first as supporting evidence. If you're not familiar with this screen, check out the video in the top right-hand corner. What I want to point out is that the outflows were significant in the past week's worth of trade, closing here roughly outflowing 800 million shares, right? And if we think about what's going on here on a daily perspective, this is the worst day that the indicator has ever experienced in the history of tracking this information. Let me quickly throw this on a monthly, and I'll just come in here and I'll expand this to max available time frame. This is what we experienced on the Friday session. That's significant in terms of outflows. The worst reading that we've ever seen in the volume flows, okay? So noteworthy point number one. Noteworthy point number two is that the advanced decline line shows us lots of volatility. It's overcorrelated down, it's overcorrelated up, down, back up, back down. This tells us that we have a volatile market, not a trending market, which hopefully you can just get the sense of as we look at the sideways range-bound activity of the last week's worth of trade. So yes, bears do have an edge with there being more downside extreme readings here, but it's a volatile bearish environment, which means that we can still experience wild upswings. If it's sell everything one day, it's buy everything the next day, squeeze out of everything, right? I would be very, very open to a wide range of outcomes, but yes, the bears do have an edge. If we look at the cumulative ticks down below on the bottom as well, almost all of them built out negative, so definitely an edge to the bears here. Slight increase on the Thursday build, obviously, as we got that news that, hey, First Republic is going to get a ton of deposits from a number of different banks out there. That kind of kept the market happy, but in the grand scheme of things, on a weekly perspective, bears definitely had the momentum on the day-to-day basis, and once again, these outflows here strike me as historically significant. Market profile is always Exhibit B, and there's a video tutorial for you in the top right-hand corner if you're unfamiliar with some of the terms that we're about to use. Overall, here is the daily balance area. It should strike you as being quite clear. On Monday, recall that we saw a short covering rally off of the lows and the open here. Those are the single prints, as well as the thin volume structure that accompanied that. And then on Thursday, this is what strikes me as being most noteworthy. The most recent interaction with the balance area is that value shifted higher on the breakout Thursday, as did the point of control. So that in theory would be an indication that, hey, buyers are doing the right thing and migrating the most value in the upward direction, right? We're moving away from content in the balance area to, hey, prices up here are actually becoming fair. It's really on the impulsive move from the bank announcement on the Thursday session, right? That left behind a string of single prints. Then the fact that on Friday, so here's the reversal of all of that bullish progress, right? The fact that on Friday, point of control moves definitively back down into the balance area. The value area is definitively back in the balance area. Doesn't really strike me that these were aggressive new money buyers. It's potentially just a short squeeze reaction here. We know that this was short covering, so pair this with the internals that we just saw, and there's still not really an argument to be made that new money buyers are stepping into this market. It's some short covering rallies, it's some impulsive, intraday scalping in the upward direction, but the fact that this did not stick and the fact that value did shift lower in such a substantial fashion the very next day does strike me as also being significant for the bears, right? This is a failed break in the upward direction, kind of tying into the bearish narrative we saw on the daily time frame chart, the internals, as well as even the weekly. So this also would say if we start to break down underneath the bottom of the balance, we could open the door for lower, which is exactly what we just discussed on the SPY 384.75. And moving back on over to Thinkorswim to evaluate the weekly performance of our sectors, I'll just remind you one last time that the percent change weekly as well as from open script is now available on our website, as is the script for the market internals to gauge cumulative volume. Last reminder, that was a big update that we made over on the site in the past week or so. Anyways, percent change on the week. Notice that the XLK tech sector led the pack here, up 6.33%, which does strike me as being a more bullish indication, noting that it's the heaviest weight risk on type sector. Obviously, it's on the indications that rates are moving lower and moving lower aggressively. Following it up is the communications sector, up 6.09%. And once again, some confusion out of the XLU, which is typically a D for defensive sector, also up 4.09%. At the bottom of the barrel, we see the energy sector, which is also D for defensive. So it's sort of like a confused market here in terms of posture. Energy down big, 4.41%. Financials, more of a risk-on heavyweight sector, down big as well, with the continued bank pain, so to speak, down 2.46%, with the mixed positioning on this list, basically, it's very difficult to say what the market is feeling right now. I think paying attention to the structural trends is always going to light the way here, specifically in these types of environments. So XLK tech sector, I mean, hard to say anything bearish about this chart. Held on to 135 like a champ, held the daily 50 SMA, right back to the top of the range, technically produced a new higher high. Very reasonable if this pulls back, finds a higher low and reattempts, that we go and try to close this gap overhead. Obviously, a lot will be hinging on the Wednesday FOMC announcement, but this is, in the back pocket of the bulls right now in the XLK. Sure, intra-week, a little bit of pullback here might produce some bearish pressure for the market, but structurally, this chart actually looks fantastic. You could even start to classify this as like a weekly bull flag that's in play. So XLK, heaviest weight tech sector, does strike me as a bullish indication for the market, even with a pullback, as long as it maintains a higher low. XLC Communications also with the higher high on the Thursday and Friday session here, offering up the clear opportunity for a higher low above 54.30, which would of course imply an inverted head and shoulders, break the neckline, and bulls are back on parade in this one. A concern would only be if we get all the way back down to 52 and revisit the top of this balance range from in here and fail that, right? So as of right now, this also strikes me as a bullish data point. Utilities, once again, D for defensive. We do not want to see them leading. They are technically above the double bottom neckline with a break, retest, and hold on the Friday session at 66.70. Now, if it just plays sideways in here, okay, fine, content. If it starts pushing for these highs up around 73, much more of a concern for our markets. Keeping a very close eye on utilities specifically in the coming weeks worth of trade around 66.70. Next up, we've got the XLY. This is also another important one to watch, noting that it is a heavier weight risk on sector, and it's actually lagging the market, right? Obviously, it's stuck still in this balance range from the past, and the risk is that we just produce a lower high back down to the bottom. You call this an H pattern, equal low flush at 135, bearish pressure for our markets. So tech looks great, communications look great. From a structural and pattern perspective here in the XLY, still some pretty big concerns. To feel more comfortable on the bull side out of discretionary, got to see a push, higher low, and then once again, maybe we start to think about inverted head and shoulders, but there's a ways to go. We're just barely resolving the head at this point in time. Next up, XLV, second heaviest weighted sector for our market by market cap, noting that it's going sideways at the monthly balance lows. Recall, if you just go to a monthly chart, you've got like monthly bull flag, just kind of hovering sideways here at the bottom of the range. Once again, I would not expect healthcare to just violently break this in the downward direction and give it up so easily. I think that we could easily see really just sideways activity down here. Think about how slow this move was. Another slow sideways grind in here does not strike me as being unreasonable for the healthcare sector, especially if the market's going to be rotating into more of like a recession type theme. Remember that healthcare typically outperforms because there's always going to be a need for health services. So with that said, continuing along to the XLP consumer staples, just like utilities, this is D for defensive, but note that it did not break or take out its neckline of the double bottom. Watching 72.50, it becomes a bigger cause for concern over 74. Bearish pressure will be bearish pressure if we start breaking down and heading towards 70.20. Next up, we've got the real estate sector, really just kind of sideways underneath the neutral zone. So this does strike me as being slightly more bearish. If it pokes back in, it's positive from a wealth effect perspective. We'll see what happens with rates. If rates start to come down more aggressively, I would imagine that real estate starts to perk back up, obviously, on that sort of relationship there, which is positive from the wealth effect perspective, which would be bullish for markets, but obviously bad for inflation. If we take a look at energy falling off of a cliff here, this is D for defensive. So as it moves lower, as long as we're seeing that XLK outperformance, XLC outperformance, this does not strike me as the end of the world. This is fine in an environment where the communications and tech sector are leading the way in the upward direction. Financials, though, obviously continued pain here. I would be very open to the idea that 31 could produce a fake breakdown and a pop back above 31. I mean, again, you're going to get shorts who are trapped down here, who squeeze out. Very difficult to be a new money short in the financial sector here, sitting dead on the lows. Sure, there was a dead cat bounce or back down at the equal low. It could flush, absolutely, but I would rather take the risk somewhere else. I would rather be a risk on long looking for like XLK, to break an equal high than trying to find a new money short in financials, for example. So could this flush? Absolutely. Could there be more pain in the financial industry? Absolutely. But making that bet at this location, not ideal from a risk reward perspective. Next up, XLB, what's going on with materials? Really lightweight sector, finding a 3-day balance down here underneath this big overhead range. It does strike me as being more bearish than bullish. If it breaks 77, it's still bearish pressure, kind of neutral in here. It won't mean a whole lot for the market, but it's technically bearish on lower highs underneath 79. Last but not least, industrials, roughly 8% of our S&P 500, breaking down underneath the bottom of the range on the Wednesday session, Thursday back in, Friday closing back down underneath. The key pivot is 96.75. 95. The more time we spend underneath, the more bearish it becomes. This obviously turns into overhead supply weighing on the market, trying to push it into that next support at 91.60. Bearish pressure clearly poking back above and remaining above 96. I would treat it as neutral for the S&P 500. Here are the sector ratios just to better visualize relative strength. If you need to know how to set it up, there's a video tutorial in the top right-hand corner. Overall, the top 4 are the risk-on sectors, and notice that things look great here other than the bad apple, which of course are financials. I'd also like to point out that the XLK tech sector, not only is this making a parabolic move in the upward direction, not only is it putting some decent distance between itself and the daily 50 SMA, if we take a look on something like a weekly time frame chart, we just made a new pivot high well above what we saw from in the past. Recall that our initial concern was, hey, we've got this resistance trendline. Great, we broke it. Now look at how much of a significant higher high was just produced on the relative strength ratio here for tech. This does strike me as being more optimistic and much more of a risk-on type look for our market. Obviously, we want to see that ripple over to something like discretionary and a stronger move away from the upward sloping 50 SMA. Nonetheless, still finding support here and grinding in the upward direction throughout the past week's worth of trade. It's really financials, right? That should be abundantly clear based on everything you see in the headlines right now. Financials are the drag in this marketplace. If we take a look at the bottom 4 risk-off sectors, it would be sort of misplaced of me to not at least recognize that, hey, we're actually above a 50 SMA down here. We're above a 50 SMA down here in the consumer staples as well as utility space. So risk off is slowly creeping back into this marketplace, but the risk on strength here, namely in the tech sector, is really still the most optimistic look for our markets in the bullish direction. If we take a look at the consumer discretionary over staples, so risk on versus risk off, continuing to try to find a bottom around this upward sloping 50 SMA. We know that we have a line in the sand, this kind of gray zone in here to find that higher low. From a trend perspective, right, it's still very clear that this is a significant higher low above what was set in December. So it's very difficult to say that risk off is fully back in play here. We're not seeing any acceleration in the downward direction like what we saw in here or like what we saw in here. Now, if that happens on a breakdown of this gray bar, we'll change our tone certainly, but as of right now, still trying to find that higher low, which speaks to risk on odds at this point in time. Taking a quick glance at the dollar, notice that the inverted head and shoulders is still very much alive with Friday's close remaining above 103.50, but there's definitely some skepticism about wanting to be in dollars with all of the trouble, so to speak, in the financial system right now here in the States. And this is evident if we take a look at the gold contract /GC, clear flight to safety, so to speak, quote unquote flight to safety. From this perspective, saying, hey, gold is the asset, it's the yellow metal that'll shine no matter what, right? So seeing that outperformance here in the gold contract, would it be unreasonable to catch a little bit of a pullback here? Absolutely not. If gold pulls back, watching to see very closely what the reaction is in the dollar, and then we can kind of make an assessment as to what should take place for equities. As we've been pointing out in the past couple of episodes here with this financial disaster on our hands, not making any assumptions about what's taking place right now in this particular relationship. If we go ahead and take a look at rates here, let's bring up the TNX. This is the 10-year rate, obviously. We're right back down at the flush point, right? So if this breaks down, that should be number one, decent for the tech sector because obviously forward margins will improve, but also start to think too that this will be decent for the financial sector as rates hit that breaking point of being almost too high and disincentive borrowing. Sure, banks make more money on the loans, but with de-incentivizing borrowing, you're not going to generate as many loans, right? So as rates actually come down, it should benefit the financial sector to some degree. So we'll watch to see how that relationship specifically unfolds, especially with the FOMC decision in the coming weeks worth of trade. Let's take a look at the Fed tracker tool. So we can see here that there's still about a 60% chance that we do get a 25 basis point rate hike in the coming meeting from the Fed, but there's some odds still of no hike. Now, I think it's very important that Jerome Powell gives at least a 25 basis point rate hike. Otherwise, his credibility goes right out the window. It's very, very important at this point in time that he does what he needs to do to separate the two issues of financial stability and the fight against inflation. Sure, they can kind of support the banks as they've been doing in some of their discount window borrowing. We'll take a look at that chart in just a second, but it's really important that the fight against inflation remains at the forefront of their mission, noting that CPI last week came in at 6%, and that's still obviously well outside of the scope of what the Fed needs as a benchmark. So if we take a look over on Thinkorswim at this particular chart here, this is the Fed's balance sheet up here on the top, and I just want to point out that yes, there was a massive injection of liquidity in the past week's worth of trade as these bailouts have been taking place for the banks. banks. We've almost undone half of the quantitative tightening that's been done in the past year or so of trade. Now, this did not directly come from a quantitative easing perspective. It's from the discount borrowing window. So technically, the time duration on these assets in the balance sheet should be much shorter than explicitly going out and buying like 30-year MBS on the Fed's balance sheet. So just something to keep in mind, that the borrowing is not essentially the same. That the addition of liquidity here is not the same as quantitative easing. Although, yes, it looks staggering that in a very short period of time, we've undone half of the work of the quantitative tightening cycle at this point in time. The TLT bonds are continuing to show outperformance here, which would not bode well for equities. There is the traditional flight to safety trade taking place at this point in time. But if we take a look at our HYG junk bonds, so to speak, they've done a really great job of keeping a level head in the equities market, saying, hey, no lower low, no significant lower low was produced. This was a way, way overreacted move from the equities market. So as long as this goes sideways in the range here, I would continue to expect kind of neutral outcomes in the market. And we'll start to look for that next confirmation signal when and if we break the highs, or when and if we break the lows. So this did a good job of keeping us level-headed down here, kind of waiting for that next signal at this point in time. Then lastly, checking in on Bitcoin from a risk appetite perspective. I mean, substantial breakout in the last week's worth of trade. Now, I get it, complete reversal based on the liquidity injection from the Fed, but from a technical perspective, at least give some respect where respect is deserved. We undercut the low here in the red week's worth of trade, which is obviously a bearish indication. Sellers should step up on a breakdown like that, not only violating this low, but also getting back down underneath the breakdown candle high. So the fact that we immediately reverse that, and then also, this is the kicker here, it's not just the reversal of the lows, it's the higher high being produced into Friday's close, strikes me as very significant from a trend perspective in terms of what should happen next year. We should expect that, okay, any pullbacks now can be met for a higher low and trend continuation in the upward direction. Once again, not a one-to-one correlation with the S&P specifically, but starting to get pretty darn close with the NASDAQ. The fact that this outperformed here does strike me as being a bit more optimistic for our markets. Just like last week, much of that risk-on optimism gets wiped away when we look at market breadth here. So new highs versus lows firmly supplanted underneath the zero mark here, making a lower low. And obviously the risk is that we morph into more of a look like what we had in 2022, which was bearish for equities. If we take a look at stocks trading above their daily 200 SMA in the S&P 500, a new lower low was made in the past week's worth of trade. And once again, more firmly now underneath the 50% mark. And if we also do the same thing with stocks trading above their 50 SMA, this one's quite telling, because as we've seen this volatile dead cat bounce, the counter trend rally, we did not make a higher high in this particular read, which would tell you that it's still just a counter trend move. We're not seeing a big bottoming process yet in the S&P 500 companies. So not true strength, just counter trend rallies at this point in time. If we take a look at the relative strength S&P 500, it's still underneath the December lows from in here. This strikes me as a bearish indication for our market. Obviously, it's the tech sector and the tech cohort that's keeping the weighted S&P afloat here and well above the December lows. This speaks to bad breath, so to speak, like take a mint, bad joke, I know, bad breath across the market and the underpinnings as a whole for the S&P 500. Taking a look at the Dow theory, this again strikes me as more of a confusing look. Here is the balance, here is the equivalent balance in the midpoint, obviously well underneath that balance. So again, I didn't really hear much from commenters down below last time around, but if you do have thoughts on the Dow divergence, let me know in the comments section. I would love to hear from you right now. This to me strikes me as more of a volatile indication. Speaking of, let's dive to the VIX. So still elevated over here, and I would imagine that that remains the case as we move into the FOMC announcement. Just recall that most major market bottoms are found when we get a capitulation spike into the 40 area. So we'll see if that takes place. If I just go out to like a 5-year monthly, this may or may not give us enough of a time frame. Let's go out here. You can see, right, most bottoms for our market. I know I don't have the comparison underneath, but you get the idea. Usually you see a spike above 40. So keeping an open mind to that being a possibility, but we'll see what the Fed has for us on the Wednesday session. If we take a look at the volatility of the volatility index, it would tell us, hey, a 40 handle read in the VIX isn't that big of a stretch of the imagination, considering that the VVIX itself is now elevated and staying above 103 at this point in time. Very, very volatile market conditions, which I'm sure if you've been trading, doesn't come as much of a surprise right now. Of course, here are the volatility futures, definitely in a backwardation well above the zero mark here in the futures, and also 9 versus 30-day VIX also above the zero line. Once again, this speaks to money managers not really wanting to go out there right now and allocate a whole ton of new capital. Here's the QQQ, obviously well above the double bottom neckline and also staying in this balance area just like we saw in the XLK. The difference, of course, is that we did not technically break or interact with the top of the range at 311.75. So that's still an upward target if we see lift in the QQQ, but the key for bulls at this point in time is keeping higher lows above 300, consolidating up here. Obviously, that's constructive in the upward direction, something that would look like this, building blocks in the upward direction. Clearly, the expected move is also much smaller, considering there's a lack of financial representation in the QQQ and NASDAQ 100. Once again, $300 is your key pivot. Bulls keep it above for reasonable bull flag consolidation like this. Bears, of course, want to see a breakdown, lower high, back down into this balance area. You target the bottom end of the range, and then maybe, just maybe, if the market does go to hell in a handbasket, we break 289.75. We can trade for lower outcomes after that. IWM, just like the XLF as a sector, is still kind of in no touch zone. There's obviously a flush point that's been built here at 171 off of multiple lower highs, lower highs, lower highs on the Friday session. So it wouldn't be unreasonable to look for this to break in the downward direction. But just like in the XLF, keep an open mind. If they come in here and sweep the lows and come right back above, there's going to be a wicked short squeeze with any trapped shorts here, probably back into the resistance trendline, maybe back into this area here at 176.75. So as I've been a proponent for on the channel the past couple of weeks, if you're going to trade IWM short side, if you're going to trade financials short side, do so with options and size your position for zero. Control your risk with the position size and not with a stop loss, because the volatility here could mean that you get jumped. There's going to be slippage. It's going to be a nasty time if there's a fake break and it squeezes in the upward direction. So please control risk, manage risk with position size. 171 is definitely a flush point. There's definitely a bear flag here. All of the bearish patterns are there. Just be mindful that, it's a wicked market environment right now. All it takes on Wednesday is the right combination of words from Powell. You see something that was looking really nasty, suddenly reverse, and you're caught holding the bag. So just be responsible if you're going to chase shorts dead on the lows of these market moves. Side-by-side weekly charts, SPY clearly can offer up a very nuanced higher low. The QQQ has the opportunity to hold this clean higher low. It's already at the top of the range here, and the IWM is probably searching for an equal low. Now recall, this is massively divergent, and it's not often that the indexes are so far out of sync. Once again, an indication of volatility. You probably don't want to be overly aggressive in this type of market environment. IWM used to be the leader in the upward direction, right? It was the first one to kind of bottom out here. It actually found the higher low, first one to break the top of the range. It was looking good for structure up here. Now that it's on the lows, it's kind of leading in the downward direction. Does it mean that the Qs need to fail and do something like this? Does it mean that the SPY will come down here? It's possible, but recall also that on the flip side of the coin, the QQQ is the heaviest weighted tech representation in the S&P 500 here. If this is breaking out up and over the top, just because the IWM is sitting down here on the lows, may not mean that you want to be aggressive on the short side, right? So this divergence, once again, is totally indicative of volatility. If you haven't recognized that in the market at this point in time, then take off the blindfold, look at the VIX, look at these things side by side. The market's getting ripped apart. Wednesday, let's pray. Let's please pray for some clarity from Jerome Powell so the market can settle down and start to develop more of an in-sync type trend, and we can take advantage of cleaner moves. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every time a new video comes out. And with that, we'll jump right on over to Apple. Notice that we're still clearly in a weekly/daily bull flag right up at the top of the overall range. We did find the higher lows above that 150.50 area and even broke the intra-range, if you will, around 154. So the objective of bulls going forward is to continue to put in consolidation above 154, then break 156.50 to get into that target overhead at 162.75. Note that back here, there's really thin structure as we approach that level, so it should happen sooner rather than later, also coming from such a substantial balance area. Typically, you look to double that balance range. I want to give you the realistic structural target first, but in theory, right, the more time you spend in balance, the more time you spend sideways, the more potential energy is built up in this area, the more positions, net positions are being built. Either the shorts get squeezed in a more substantial way or the longs are rewarded in a more substantial way. The longer the balance, balance, usually the bigger the move. So watching 156.50 like a hawk, considering this Apple weekly / daily pattern here. Next up, Netflix is in play as a downside trade, right? We did find that lower high counter trend rally off of 312, 315.50 zone. Looking for continuation in the downward direction. Let's go to an hourly time frame chart. Can show you this one clear as day. Beautiful rejection in here, but what's the concern, right? Obviously, it's the 298 100% retracement dead cat bounce. So watching for any continued lower highs around this area and then a flush after the equal low is where the more attractive short comes back into play. Or if that's even still too aggressive on the short side for you, it's waiting for the flush of 291, which on the daily chart, a breakdown there gets you back to 280.50, roughly a 10-point range in the downward direction. So still favoring shorts with the relative weakness out of Netflix in this overall move. I will change my tone if Netflix finds a higher low above this zone in here. Next up is Tesla. Extremely interesting chart still, noting that this balance overhead is continuing to give us rejections. Technically, we undercut the Thursday low on Friday's session. We overcut the high, right? So an outside bar, but a closure inside of this balance range. Going to the hourly time frame chart, once again, the levels become quite clear. Head and shoulders on a continued lower high underneath 185. Breakdowns here get you down towards those equal lows. 173 breakdown on the daily is much more aggressive. And then the bulls, it's still a patience play for the bulls. Honestly, it's got to be the higher low back above 188.50 to accept back in this range. Otherwise, I don't really think there's much going on from the upside perspective. So really favoring Tesla downside as long as it remains underneath 188.50. That's the big pivot in Tesla. Next up is Google. I've got to give credit where credit is due. Communication sector was on fire this past week. Google, big constituent there, huge move over the double bottom neckline. So I'll take it as it lies. Coming off of the daily 200 SMA, pullbacks want to remain above 96.80, and from there, higher lows are on the table, right? Continuing this trend reversal back in the upward direction. If it does continue to just creep in the upward direction, not a proponent of big new money longs at these highs. You're setting yourself up for terrible risk reward if you're trying to long this up here at the top. Could there be something at $100.50? Maybe. You'll notice that there's some consolidation above, but this thin structure is ideally the risk. If we break down underneath this area, that's where the pullback unfolds. Maybe if you're a really astute intraday trader, you can scalp it in the downward direction there, but don't overstay your welcome. Recall, you're looking for the higher low off of 96.80 back on the upswing. Next up is the metaverse. What's going on with Zuckerberg's Fantasyland? Finally getting the pullback, right? This break right back to the top of the range. Wanted to see something into 188.75 sooner, but hey, it's unfolding. It's coming to us. We want to wait and be patient. Can we find the long on the break and retest of this area right here? Break, retest higher low pullback, then get continuation back in the upward direction. That's the game plan for Meta as we move into the coming weeks worth of trade. If we break down underneath 188.75, willing to look through this gap in here. Obviously the upswing on this rotation back above 201.25. Scrunch up this chart and remind you that, again, the structure over here is thin till we come into the back test of 221. Next up, we've got NVDA. Just an absolute monster. Again, hopefully nobody was short this. We have been saying week in and week out, do not short NVIDIA unless we're moving through the gap range. And that hopefully played out either by not being short or maybe you even caught the long on Thursday. Whatever happened, hopefully you were on the right side. Now, as we move forward, I'm just showing you where this resistance is coming from, where these upper targets are coming from. Say it with me. Say it in unison. Are we going to be new money longs up here on the brand new higher high? Absolutely not. The risk reward is not favorable. The favor was breaking out of the balance range. We've doubled that range, right? So boom, boom, more than doubled that range. And we actually closed a gap. Let me also remind you, NVIDIA, there's a lot going on here. We closed this gap on the Thursday-Friday interaction, right? This gap from in here. So is it reasonable that we catch a pullback? Absolutely. And just like Google, if we take a look at the hourly time frame chart, the threat is that we rotate through the thin structure fairly quickly. So obviously the breakdown of Friday's low is what you're watching for, 257. If we're underneath it, I wouldn't be fishing for longs until we come into structure closer to 242, the back test of the top of the range. And on the daily chart, that looks like a clean break, retest, and then trend continuation in the upward direction. Next up is Softy. I'm just going to echo the same exact sentiment. Did not quite fill the gap like NVIDIA did, but once again, no new money longs. The risk is through the thin structure on the downside. Taking a look at the hourly time frame chart, you do have a little bit of support here. It's not Friday's low that you want to watch. It's 273.75. Then the thin structure is in play, looking for higher lows off of 266 if the more aggressive pullback happens for something that would do this. Obviously, this remains structurally significant as long as we're above 260, the double bottom neckline. A little bit different than the structure over in Google. Last but not least, the mini beast is going to be Amazon, the laggard, but it did offer up a clean break on the Thursday session. We were saying, hey, if this is going to play catch up to the tech cohort, watch out for 96.50. It finally went, and now we have a very, very clean 3-bar play on the daily time frame chart. So if the market continues to rip in the upward direction, you're probably not looking to chase Google. You're not chasing Meta. You're not chasing NVIDIA or Microsoft. Look at Amazon. What a beautiful setup, right? Long over the 2-bar highs, targeting up here this structure at 108, also daily 200 SMA, and we're defining our risk with the 50 as well as Friday's low, right? So this setup, much more reasonable if we need continuation longs. If the market's pulling back, obviously you're not going to long this. You're going to look for those short setups probably in something like Netflix, considering the relative strength, but you get the idea, right? If the market continues to pump and you don't want to chase, Amazon's probably the place to do it, right? So that's going to do it. Let's move into these trade ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all that good stuff YouTube tells us to tell you about. Let's dive right into these trade ideas. MDLZ Mondelez is up first, looking for a break of this weekly bull flag, monthly bull flag, whatever you want to call it. First target is always the top of the flag range, much closer to 68.80, 69 even. If we zoom in on the daily time frame chart, the reason this is attractive, of course, is because we have consecutive higher lows building out, inside bar on the Friday session, multiple lower wicks supporting off the daily 50 SMA, crack this cluster of highs, and once again, I think we could move closer towards that 69 target, up towards the top of the overall range. The liquidity on the options chain here is horrendous, so consider taking shares if you were otherwise going to go in with a large options position. So just a consideration there. Next up, BSX. What's going on with Boston Scientific? That's the name of the company. Ascending triangle, very clear here. A break of 48.37 puts us into blue sky territories. This is brand new highs, and just like what we talked about on Mondelez, inside bar on the Friday session, just consecutive higher lows coming into this breakout point looks attractive, especially considering the blue skies overhead. Next up is going to be ABNB, Airbnb. What's going on with these short-term rental programs? Looking pretty good on a 3-bar play. So inside bar, more specifically in the upper 50% of Thursday's range. If that momentum is going to stick, if the bounce off the 50 SMA is going to stick, looking to retrace through the thin structure back into the breakdown point here from 125.85. The hourly chart always does wonders in terms of showing you the structure, right? Inverted head and shoulders is the idea. It's a daily 3-bar play. It's an hourly inverted head and shoulders. Looking for the equal high break. Risk can go here for like swing traders. Overall, right, we're making higher lows. You get the idea. 120.13, 120.15, breakout point, 125.85, breakdown point from here acts as your T4 target. Next up, we're going to take a look at PENN, PENN Entertainment. I thought it was PENN National Gaming. I don't know if the name changed on the merger or something like that, but good old El Presidente. What's going on with his company back here? 3-bar play. Once again, that's the name of the game right now. 3-bar plays inside the upper 50% of the Thursday range, looking for a break through the thin structure just to the retest of the breakdown point. Very similar to what we just saw in Airbnb, but this is more aggressively counter trend. Keep that in mind if you're going into this, right? So again, inverted head and shoulders, the idea, the thinking, the pattern is all the same. 27.75, 29.60 on the target. Much smaller range to trade for. Obviously a cheaper stock. Might want to do it with shares if the options market is not so liquid here. I'm not sure. I haven't traded PENN options in quite a long time. ABBV, ABBV is our last culprit over here. Daily time frame chart does it justice just fine. Here's a breakout point. This range was on our radar in the past. Look above and fail, look below and fail, right back to the top of this most recent range. I love the engulfing bar on the Friday session. Technically, we undercut the Thursday low, rally off of support at the daily 50 SMA, close in the midpoint of that range. Cracking over these highs looks attractive to rotate through the thin structure on the breakdown to the breakdown point. Hopefully you can recognize the theme so far in today's trade ideas. 160 is the retest. This isn't as aggressive as a counter trend to what we just discussed in PENN. Obviously, you've got much more sideways activity happening here, so the breakout might happen a little bit more easily. That's what I've got for you in today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comments section, or by giving the video a simple thumbs up. Check out all the links down below in the description. I hope to see you tomorrow morning live at 8:30 for our pre-market prep. Have a green trading week.